Welcome back. Episode 16 of Making Sense of Your Money. I think maybe I'm saying more welcome back to myself. I am back from a little paternity leave. Just so everybody knows, baby and Jen are happy and healthy. Not quite getting as much sleep as I used to, but we're making do. So today we are going to talk about the Secure Act 2.0. So there's a lot of information there. You could certainly, get online and start reading it all. I would say you might fall asleep. So if you're having problems sleeping, dive into it. But we kind of want to just, get on here and give you some of the highlights, the key takeaways that we think that might pertain best to our clients. So, really, it's 100 new retirement rules for individuals and businesses. So, like I said, a lot of information here. So there's a lot of good strategies on just how it might be able to help you. And we're going to kind of touch on some of these key points here. So, key number one, they're giving you more time to save for retirement. So I'm going to let Elizabeth kind of dive into what does that exactly mean. And she's going to kind of pop up some dates on the screen and kind of give you that information.
Awesome. Thanks, Jeff. And welcome back. Very happy to have you back and back on the team, ready to go. So yeah, starting with this more time to save, right? One of the first big things that is being adjusted is those required minimum distributions. So let's go back a little bit of time. Back in 2020, when Secure Act 1.0 came out, they pushed those required distributions from 70.5 to 72. And that was a lot for back then. However, now they're going to push them out even further. So who does that affect? Anybody who's born before 1951, no changes, status quo. You're going to start taking your RMD as you've already known. However, those individuals that are 1951 to 1959, your new RMD age is going to be 73. And anybody born 1960 or later, that new required minimum distribution, RMD age, is going to be 75. So for many individuals who don't necessarily need access to the money, this can be a great thing to potentially push that money off of their taxable income, if that makes sense, or do some of those other strategies that we've talked about where it might make sense to fill up buckets through conversions, things like that. So can be a big opportunity potentially for a few more years for a lot of our clients.
So basically the IRS getting their hand out of the cookie jar for a few more years, right?
A few more years, yes. But keep in mind, one of the important things to remember with that is that the longer that the IRS keeps their hand out of the cookie jar, the bigger their lion's share gets. So that's why it is really important to make sure that you can look at that age and say, okay, out of sight, out of mind till 75. But again, that's a huge thing that we do with planning with clients is, hey, is there some things that we should be taking advantage of to maybe let their hand in there a little bit so that we don't have a big problem when we get to 75. A couple other little things is that there's no more age limit in contributing to your IRA. So even if you're past that 70.5 age, you can keep on going so long as you have earned income. So that earned income component is still going to be there. We do have clients that we work with who work through their 70s, happy to do it. For those individuals they want to put into an IRA, all systems go. You can still do that. And then finally, are these enhanced catch-up provisions. A lot of this is going to be starting in 2024. What we're going to see is for those 401ks, 403b employer plans, is those catch-ups aren't just going to be necessarily a flat dollar amount. They are going to have some indexing for inflation, which will be really helpful for those people who want to be able to plug away and save that extra money as they're getting close to retirement. Of course, we got to have a couple age brackets with this too, because why not make things a little complicated? And as it stands today, those 49 and younger, there's still going to be no catch-ups available. So it's going to be whatever that stated amount for those 401k and 403b contribution limits is, which is kind of what we're used to now. Where it's going to start to shake up is people who are between that 50 to 59 bracket and then 64 and up. Those individuals are going to have $7,500 that they can put away with starting this year as that catch-up provision. And then we have this like sweet little segment of ages of 60 to 63, and they're going to get even more catch-up ability. And what they can do is put away the greater of either $10,000 or $150,000 of whatever that standard catch-up amount is. That's a lot to unpack.
Yeah, so obviously, if you have questions there, you can reach out to us. So we're not going to dive into that, any deeper right now. But number two is they'll give you more ways to save for retirement, which is obviously good. So Elizabeth, can you touch on some of the ways that they're going to, kind of open up for you to save a little bit more?
Yeah, some of this is really starting to push some more pressure on employers, which is a good thing. Making employers be more involved in the retirement process, right? As pensions have kind of become the way of the dinosaur, these 401ks, 403bs, employer plans is for most people like their bread and butter walking into retirement. So the Secure Act really wanted to focus on how do we make employers be able to provide plans and provide enough for people to be able to put in to fund them properly, things like that. So that's what we're going to get into now. The first is that starting in 2025, there's going to be a mandatory auto enrollment that companies have when you start at a new employer into that 401k and 403b. What they found is that, when people start saving right out of the gate, even if it's a small amount, they tend to stick with it. If they start to kind of earn that income and then 6 months, from their start date, they get shoved a packet of paperwork and say, sign up for your 401k, it's very easy to kick the can down the road and just not deal with it. So this is really something that they honed in on, that auto enrollment that's going to start happening in 2025. Roth accounts. So Roth accounts have typically, we always have had kind of those Roth IRAs. They've started to become more prevalent in your 401k and 403bs out there in that type of market. Where we're seeing them now in the Secure Act 2.0 is they're actually going to be opening up to both simple and SEP IRAs, which is huge, especially for very small businesses who maybe couldn't afford to have a Roth 401k option, and then also for our self-employed individuals. So many self-employed individuals are taking advantage maybe of those SEP IRAs, and all they've ever been able to do is pre-tax into that, which means taxable money later on, which is helpful now, but maybe not down the road. Being able to have that Roth option is going to give that flexibility and also the ability to put into potentially both for that employee. So they can have some money that's pre-tax and then some money that's going to be tax-free down the road.
So again, a lot to unpack there. So also there's new ways to use your money. And if you're anything like me, when you hear that, your ears kind of perk up a little bit. So can you go through that and just talk to us about the new ways you're able to use your money?
Absolutely. So the first thing is in regards to charitable contributions. So we talk about these. If you've ever come to our IRA seminars, we've done some digging this. We have clients who this is a big part of their planning, which is how do I make sure that I can take care of the charity that I want to take care of, but do it in a way that's not going to hurt me tax-wise by taking money on my IRA. So there's these charitable contributions that we can do on a yearly basis, and they've always been capped at $100,000 per year. Though that's going to change starting next year, that's going to be linked to inflation. Outside of that, what I would say when it comes to new ways of using your money, the Secure Act is all about how can we provide more flexibility. Some of the things that they've hit on is 529 plans. You can actually now take out $10,000 from those to repay student loans instead of having to withdraw that money potentially from your retirement account to do so. A really cool one that's out there too is, let's say you did fund those 529 plans and the child doesn't use it all, or maybe they use none of it. They could transfer up to $35,000 from that plan, that 529, now to a Roth IRA in their name, which could have a huge jumpstart, right, on what they're doing for retirement. And for a lot of our clients, I see this as a great tool because that 529, for some, they were always concerned with what if we don't use it all? Well, this is a great place that we can kind of shift that money and still have it be for the benefit of the child. And then last is that starting at the end of 2025, employees can start to withdraw $2,500 each year from their company's retirement plan to actually pay for their long-term care coverage. So if they have premiums out there for long-term care, they're really trying to encourage that, obviously, is, hey, every year you can take out $2,500 penalty-free to be able to pay for those long-term care costs.
That's pretty cool. So I think that that's going to be able to help a lot of people and put people at ease, especially with the 529 plans. You could just roll it right into the Roth. That's really cool stuff. The last thing that I'm going to ask Elizabeth to kind of talk about is they've changed the rules on what happens when you inherit an IRA. So I know that sometimes this can get a little confusing. Can you clear this up for us, Elizabeth?
Yeah, this was a big one. This actually started back with the first Secure Act in 2020. Some of this came into play, and they really just solidified it with Secure Act 2.0. This is probably one of those things that, from the planning perspective, we aren't so excited about. For all the years that I've done this, and Jeff's worked in this industry, we've had this really neat thing that in the event that you passed away and your assets went to your children or your nieces and nephews or your grandchildren, whoever it may be, let's say it wasn't a spouse, they could take on those IRA assets and deplete them over their life expectancy. In many cases, there'd be a balance when they pass. And then that, I mean, we're talking about legacy money at that point. It was a really cool thing. They called it stretch IRAs. They don't want to do that anymore. The IRS, what they want to do is they want this tax money to be paid out, is really what it comes down to. So it's the extinction of these stretch IRAs is really what we're seeing in Secure Act 2.0. What I mean by that is when any IRA assets are inherited, and this also couples with 401ks, 403bs, really any qualified money, as we would call it, is inherited, whether it's Roth or traditional. If it's not a spouse, if it's not someone within 10 years of whoever passed away, that if the beneficiary is not within 10 years of age of them, and if that beneficiary is not chronically ill, if they don't hit one of those three things, the account has to be depleted within 10 years. So that, once again, is a big one when we're talking about planning, because we used to have an account that, really it would be a tax burden to the beneficiary, but in many cases would be negligible. So that's the concern with these. There's a lot of planning, a lot of things that we can do now that we know this is the rules that we need to work with. But it's something that you need to be aware of, that once again, if it's not going to a spouse, it's not going to someone within 10 years of your age, or they're not chronically ill, that account has to be depleted within 10 years. And we have to understand what the tax consequences will be to those individuals.
Sure. So, I don't know if I said this earlier or not, but again, we're not certainly giving tax advice. So, I think that it would make sense for us to talk about this on an individual basis and then loop in your accountant if we are going to take advantage of really any of these, just to see how it would affect you and your individual situation. What I would encourage everyone to do is, if you think this would be beneficial to someone that forward on this video. There's a lot to unpack here. We're more than happy to talk with anybody about it. So feel free to schedule an appointment through our Calendly link to chat about any of this. So if you have any further questions, feel free to ask. And as always,
go Bills.